Before buying any stock, check these 4 warning signs. Because sometimes the biggest losses aren't caused by a market crash. They're caused by buying a company that was already showing signs of trouble. And the scary part? The stock price can still look completely fine until suddenly it doesn't. Here are 4 red flags I check before buying a stock. Number 1. Declining revenue. Revenue is the money a company generates from its business. If revenue keeps falling year after year, that's a major warning sign. Why? Because a company can't grow profits forever if its underlying business is shrinking. Let's say you find a company that made $10 billion last year. Sounds pretty good, right? But then you check the numbers and realize it made $9 billion the year before that and $8 billion the year before that. That's 3 years of declining revenue. And now I'd want to know, what's going on with this business? Is the company losing customers? Is demand falling? Is a competitor taking market share? Or is this just a temporary slowdown? A falling stock price might be the result of falling business performance, not a buying opportunity. Number 2. Shrinking profit margins. Revenue can be growing while the actual business is becoming less profitable. For example, imagine revenue increases by 15%, but operating margin falls from 25% to 15%. That's a big warning. It could mean the company is spending more to generate each dollar of revenue. Maybe costs are increasing. Maybe competition is forcing prices down. Or maybe the company is sacrificing profits just to maintain growth. Don't just ask, is revenue growing? Ask, is the company becoming more profitable as it grows? Number 3. Excessive debt. Debt isn't automatically bad. In fact, many successful companies use debt strategically. The problem is when debt becomes difficult to manage. Look at the company's debt, cash, and interest expenses. If a company has billions in debt but very little cash flow to service it, rising interest rates or falling sales can quickly become a problem. Here's the simple idea. Strong cash flow plus manageable debt equals healthier balance sheet. Weak cash flow plus massive debt equals warning sign. And during difficult economic conditions, highly leveraged companies can get hit much harder than companies with strong balance sheets. Number 4, and this one is often overlooked, is free cash flow. A company can report strong earnings while its actual cash generation looks weak. That's why I like checking free cash flow, which is roughly the cash left after the company pays for its operating needs and capital expenditures. Imagine a company reports net income of $1 billion. But free cash flow of minus $500 million. That doesn't automatically mean the company is in trouble. There could be a perfectly good reason, such as heavy investment for future growth. But you need to understand where the cash is going, because eventually, a business needs real cash to fund operations, invest, repay debt, buy back shares, or return money to shareholders. So before buying a stock, run this quick checklist. 1. Revenue. Is the underlying business growing or shrinking? 2. Margins. Is the company becoming more or less profitable? 3. Debt. Can the company comfortably handle its obligations? 4. Free cash flow. Is the business actually generating cash? If you see multiple red flags at the same time, don't automatically assume the stock is cheap. It might be cheap for a reason. And here's the most important point. These 4 warning signs can't predict a stock crash. No fundamental metric can. What they can do is help you identify companies with weakening fundamentals before you put your money at risk. So don't just ask, how much can this stock make me? Ask, what could go wrong? Because sometimes, the best trade isn't finding a stock that's about to explode. It's avoiding the stock that's about to fall. Do your research, protect your capital, then look for the opportunity.